Now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it is Thursday, second best day of the week. Also means Michael Lebowitz is joining me this morning, talking a little bit about the 2026 kind of market outlook in general. So we'll just kind of go through some of that today. Talk about Fed, talk about interest rates, talk about a lot of that stuff. Few kind of headline story, interesting story. Today you can pretty much bet on anything online, right? So we've now had so much going on with, kind of online betting for sports and gambling events of all different types. Of course, with the invention of poly markets, you can now pretty much bet on anything from, who's going to throw the first pitch to how long the national anthem is going to be at a sporting event, all those type of things. Interestingly enough, somebody bet $32,000 that Maduro would be removed from office by January. And that, of course, that bet hit, made $427,000 on return. They also made three other bets, all revolving around, by January 31st, all revolving around the use of troops and the implication of the War Powers Act. All of those hit. So somebody, I'm just saying, somebody knew something that was betting on poly markets. So maybe they were just padding their federal pension a little bit. I don't know. I'm just saying, you get, that's what's kind of going on. Again, because you can create these bets on anything. So, these are just kind of very loose betting markets. So somebody may have had, I'm not saying anything in particular, just may have had a little bit of inside information. All I'm suggesting.
What are the odds?
What are the odds? Exactly. That's the odds are what it's all about. May the odds forever be in your favor, as the saying goes. Anyway, also going on in Washington is the ongoing debate right now about healthcare subsidies. There's this vote that's about to go on. If you want to know why your healthcare costs are so expensive, it's the healthcare subsidies from the Affordable Care Act. There were kind of two things in particular that the Affordable Care Act did that really skewed healthcare prices. And again, once you institute a third party into the decision process between a buyer and a seller, you're going to completely kind of skew the pricing of that when you're providing subsidies. Again, this is why subsidies are never a good thing, right? You give child care subsidies, that's great. It just increases the cost of child care and usurps the whole purpose of the child care subsidy. You insert subsidies into healthcare, insurance companies are going to raise their prices, right? Because you're getting a subsidy. So that makes the prices go up. The other thing was also basically combining risk pools. We used to have a separated pool for high-risk patients. In other words, people with pre-existing conditions, they were in a separate pool, particularly here in Texas. And then you had your healthy constituents in their normal pool. And the way the pools work, it's all based on actuarial stats, is that, you've got so many people paying into a pool, and the hope is that people live well and healthy and they won't draw out of the pool, and that keeps costs down. But once you start putting high-risk patients into a pool, they immediately start drawing out of that pool. Premiums have to go up to cover it. It's just math. That's just the way it works. So, what's interesting is there's this big debate going on right now about these healthcare subsidies, because healthcare is going to go up without those subsidies. You're going to have to pay more out of pocket. That's the problem. But the subsidies are the problem for higher healthcare costs. So one of the ideas that's actually getting floated around the Senate, so how do you fix the problem, right? The problem is that to solve the problem, you need to bring competition back into the marketplace between the buyer and the seller. This is why plastic surgery is a great example of a good healthcare system, because it is all based on competition. It is a cash out-of-pocket surgery in most cases, right? Augmentations, those type of things. You're going to pay for that. Well, you can shop around, get the best deal, get the best doctor. Those prices compete. It keeps costs down, keeps quality high. That's exactly the kind of healthcare system you want. But the problem now that we've got to get to is getting that back into the system. One of the ideas that's getting kicked around in Senate right now is passing healthcare savings accounts for everybody. Right now, you can get an HSA, but only if you have a high deductible health plan through your business. The problem, and they're great because, as Danny's talked about here on the show, those are triple tax benefits, right? It's tax-free going in, it's tax-free coming out, it grows tax-free. So, it's great. You use it for healthcare. Helps reduce your costs. You save money. You can go out and shop anywhere to get your health care at a better price. It brings competition back into the market. This is actually getting talked about in the Senate. There's a bill floating around Senate right now trying to bring health care savings accounts across the entire board. This would be a great feature to help start to bring down the competition of health care. So that's going on right now. Also, yesterday, something that I've talked about here on the show before, Mike and I have actually discussed this several times, is that one of the big problems with home affordability, right? We've talked about housing before. And the problem with home affordability is that you've had these big, massive corporations coming in and buying literally thousands of homes to turn them into rental properties. I mean, they buy BlackRock, good example, buy entire neighborhoods of houses, turns them into rentals. Well, that brings that buyer, right, provides a lot of demand for the market. That's brought up the prices of homes, adding to not being the entire cause of home affordability, but definitely a piece of that home affordability problem. The other problem was zero interest rates for way too long. That caused a problem as well. Adjustable rate mortgages, all of these no money down mortgages, et cetera, also provided a lot of demand into the housing market that brought housing prices up, made them more unaffordable. But yesterday, President Trump announced that he's going to impose a ban on corporation buying homes. It's a great first step. This has been a problem for a while. Institutions should not be buying houses. Now, again, you've got to be a little bit careful. There's a little bit of a slippery slope. There's a lot of individuals that buy rental properties. You, me, Brent. We go out and we buy a rental property as part of our investments into assets. But what they're specifically looking at is big major corporations that are buying lots and lots of homes, banning them from the marketplace. I don't know if he has the executive authority to actually make that work. We'll see what happens. That may actually have to go through Congress, but it's at least something that we've talked about here on the show before that is a problem. And this is a really good announcement, at least putting them on notice that there's potential risk that they're going to be excluded from basically creating a deformation in the housing market by their activity. So again, we'll see what happens, but kind of a lot of news yesterday. Also talked about yesterday about banning buybacks for defense companies and dividends from defense companies. Defense stocks took a hit yesterday. Raytheon was down about 2% yesterday. That literally lasted overnight. They're up 4% this morning on Raytheon. But he wants them to focus more, be more efficient on producing their military weapons on time, maintaining and upgrading them more readily, more speedily. And so yesterday that conversation went through. Stocks took a hit yesterday, but they will be coming back this morning. So anyway, lots of activity coming up from Washington yesterday. Let's talk a little bit about the markets. This is what you need to know before the bell this morning. Because of some of those announcements yesterday, particularly about the defense stocks, we did see a bit of a roll-off in the market. So we had hit an all-time high on Tuesday, and then yesterday markets did actually, we actually hit a new intraday all-time high yesterday morning and then sold off into the afternoon, closed a little bit lower. Markets were a little bit weak this morning, kind of flattish, at least so far right now. We're seeing a little bit of red in the technology space. Yesterday, Eli Lilly and Google were big winners in the markets yesterday. Healthcare continues to do well. Healthcare, we had talked about last September as being extremely oversold. We said, healthcare is extremely oversold. We added to some healthcare stocks in our portfolio and said, there's an opportunity here. We're going to see a rotation in the markets. That rotation has now occurred. Healthcare is now the most overbought sector. I was posting some charts out on X this morning showing that. But healthcare is now the most overbought sector, and staples, utilities, real estate are the most oversold. So we may start to, kind of start thinking about portfolios, looking for some opportunities in kind of some of those more defensive names, because if we do get some volatility pick up in the markets, we might see that rotation again within the markets. But overall, markets are doing just fine, well above their moving averages right now, still on a buy signal. One of the kind of the catalyst for the markets over the next couple of days is that the Bloomberg Commodity Index is about to rebalance. So we may see some volatility within the commodity sectors in particular, which have been doing very well lately. But some of those sectors, they have to rebalance that whole index, which is going to put some pressure on some commodities that have been really outsized winners, gold, silver, et cetera. So kind of watch for that commodity rebalancing of that commodity index. I believe that happens between the 9th and the 15th of the month. So again, that's coming up starting, I think, tomorrow. So anyway, just something to kind of watch for there. But again, overall markets are doing fine. Trend is good at the moment. And again, there's not a whole lot going on right now. There's just not a lot of news. Friday, we're going to get tomorrow, we'll get the next employment report. That's going to be really the first kind of report for the new year that's going to be kind of important for the markets. And then week after that, we're going to start earnings. So things are going to start to pick up. A lot of this very quiet period we have right now is going to start to kind of fade behind us. But again, with volatility very suppressed here, markets are going to be much more subject to kind of sharp movements based on the data when it comes in. So again, just kind of be a little bit cautious with your allocation between now and really kind of the next 2 weeks. All right, that wraps up what you need to know before the bell this morning. Also, next Friday and Saturday is our next Friday night. We have our mixer. Next Saturday, January the 17th, we have our Economic Investment Summit. That is Saturday, January 17th, live and in person. If you haven't got your ticket yet, be sure and get by the website, realinvestmentadvice.com. Click on the link above, get your ticket. We've got a few tickets left. Love to see you there. It's going to be a lot of fun. Got a lot of stuff we're going to be getting into about markets next year and interest rates and bonds, precious metals, et cetera. We're going to be covering it all, our outlooks on all these kind of different markets and sectors. That's Saturday, January 17th. See you live in person there. Get your ticket now online at realinvestmentadvice.com. Okay, we'll be right back with Michael Lebowitz. Don't go away.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
What's the future of investing in 2026? Gain insights on how AI, technology, and the economy will shape your money in the year ahead at the RIA Economic Summit, January 17th at the Royal Sonesta Houston Galleria. Join Lance Roberts, Michael Lebowitz, and Thoughtful Money's Adam Taggart, plus top minds in AI, crypto, and retirement strategy for a powerful look at the markets of tomorrow. Seats are limited. Register now at realinvestmentadvice.com. realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show. One of the comments in chat this morning is buy defense contractors on dips. You had a one-day dip. If you didn't buy it yesterday, you missed it. We've owned Raytheon Technologies now for a couple of years, and we've always wanted to try to add to it get the stock to pull back a bit so we can buy it. It just never gives you a pullback. It just kind of keeps going up over time. It's been a great position, but that's just kind of one of those things. Anyway, couple of things again as we kind of look forward. Michael Lebowitz will be kind of live at our Economic Summit. Again, next Saturday. It's just right around the corner. So if you want to meet Mike in person, be sure and get your ticket. We'll have a lot of time to kind of mix and mingle and talk and visit about things that are important to you. So we'll be covering that at the conference. So Mike, a couple of things here is that kind of looking out at the 2026 landscape. This is kind of the big conversation right now. Is there's kind of estimates kind of all over the board. Here's a chart of Wall Street's S&P 500 forecast for 2026. And estimates range from anywhere between a 3% advance to a 18% advance. And Brent's going to get this up here in a second. There we go. But again, estimates are kind of all over the board. But they're all positive, right? I mean, nobody expects a down year ever on Wall Street. So again, not surprising. Nobody ever comes out and says, "Yeah, I think markets will be down 10% this year." That's never the case in Wall Street forecast. But again, it's a wide range. Kind of the average, kind of expectation is somewhere around 9-10% this year. Kind of returning back to more normal average returns after 3 years of near 20%. A 10% return next year would probably feel pretty disappointing for a lot of individuals. But, kind of what you're thinking for kind of 2026. I mean, we've talked about a lot of stuff here on the show, and, there's a lot of things kind of up in the air that'll happen this year. And again, most of the things that we think are going to happen won't happen. And the things that we don't know are going to happen, those are going to be the things that matter. But, that's the way markets always work.
And that's really the theme of of my article that I put out yesterday, and what I think. Instead of, Wall Street's always out there guessing. And like you said, what are they, 9% this year?
Mm-hmm,
that's right in line with the historical average. It's an easy guess. A couple of them are 18, one of them I think is down at 3 or 4%, something like that. So, we can guess all we want, and it's it doesn't matter. What matters, in my opinion, is just thinking about the events that we know will come to fruition throughout this year. And then you can try to think about some of the other possible events that will occur. The problem with that, I guarantee you, is that there are going to be things that are going to happen next year that were on no one's estimates, no one's bingo cards. So I think it's just wise to think about the big ticket items and what potentially the market has in store. And I think it always pays to just start with a little perspective. So like you said, the average is 9%. But on average, there's an 11% drawdown from the first day of the month, from the first day of January. So we could close, on average, we close 9% higher. At one point, we're up 16% on average, but there is one point in time where we're down 11%. So that's a lot of volatility in a normal year. Also important, we've had 3 years in a row now of a winning streak. We've only had, it's going back to 1928, we've only had 4 years where we've had 5 years where we've had more than 4 years or more. So this winning streak is also, it's not a problem. It's just something to think about, that we're starting to get into rarefied air here with how many years in a row the market can go up without taking a break. So my biggest concern, Lance, I know you've been voicing this a lot, is just valuations. Before we talk about what the Fed's going to do, what President Trump will do, Congress, midterms, all that, you just have to kind of look at the environment. And valuations are very high. There's a few graphs, and I could have picked out 100 graphs to paint the same story. But the risk is that, even if earnings stay the same, that the multiple price that investors are willing to pay for $1 of earnings just comes down. Mm-hmm. And you end up with a down year. The economy can be fine. Earnings can be fine. There doesn't have to be bad news. There just has to be a change in investor sentiment to some degree. And remember, these magnificent stocks are now a good chunk of the S&P 500. So you just need a valuation adjustment in 5, 6, 7, 8 stocks. Other stocks may be fine. And that's another lesson, is that just, let's just say valuations do regress back towards the norm, the market's down. Not everything is going to be down. You noted that utilities and staples and real estate are pretty cheap right now. Maybe this is the kind of year where the S&P is down 5 or 10%, utilities are up 5 or 10%, staples are up a few percent, and you have a mixed performance among all the different sectors and factors. And if that's the case, understanding kind of this rotation game between sectors, between factors, between types of stocks could be a critical portfolio risk management tool this year, as opposed to just buying 8 stocks and going to bed for a year.
Well, or it might be 8 stocks again this year. I mean, we don't know. There's certainly, and this is right, Mike, this is the challenge that you're talking about, though, right? It's there's a lot of these things can happen, and it doesn't require some catastrophic event. I mean, there's a lot of people running around the internet right now, with headlines, market's about to crash, it's the end of the fiat currency, it's this, it's whatever, it's debasement. You can go through the long list, and this is all why stocks are going to crash. Generally, those things don't happen, and you don't need those things. And the important point here, Mike, is that you don't need those things to happen. All you need to have happen is just the markets to start to question current valuations, and valuations are very, very high. I mean, we've got very high, elevated valuations right now. Sentiment is very high. We've got a lot of momentum, a lot of push in the markets. Everybody's kind of chasing the same baskets of stocks, speculating in the same areas. But it doesn't take much to just change a small component of that outlook that creates a contraction in the markets. Again, then markets just look for some, money doesn't leave the market. It just transfers where it goes to. So, maybe this is the year that Treasury bonds do fantastic because it's a risk-off trade, and you start to see some, areas more defensive in the markets like staples and utilities because of their yields in a lot of cases, perform a lot better. And again, it doesn't mean that, and because those sectors make up smaller sectors of the market, if you have financials and technologies down, the S&P index is going to be down for the year, even though those sectors might be doing great.
Yeah, and that's exactly right. And as I was writing this article, I started with valuations, and you kind of come to that conclusion. Mm-hmm. This could be another Mag 7 year. This could be the year of utilities and treasury bonds or staples or whatever it may be. So, you can't just say, okay, we're going into utilities and staples on January 3rd, and we're going to ride the year out because we know we're right. We don't have any idea what's going to happen. Will valuations stay the same or won't they? And that's why it's important to just think about the known and try to consider the unknown. And how will that affect the economy? How will it affect valuations? Most importantly, how will it affect investor sentiment? So right off the top, we know we have QE. Remember, it got kicked off of mid-December,
right?
Early December,
right? So
just starting to think about things, that the market has this push behind it. It's 40 billion, right? 40 billion a month.
Yep.
That will slowly accumulate. So there is a natural runoff in reserves, but now you got this supporting bank of liquidity that's starting to come into the market. And it may take a while to offset the declining reserves, but at some point we know that QE should support the market. And we wrote an article about this 3 or 4 weeks ago before the break that talked about the correlation between the change in reserves, change in liquidity, and which sectors, factors, financial assets tend to do well. In the article released yesterday, I just share the sectors. And we know that transportations, materials, discretionary, financial tend to have a high correlation. Interestingly, utilities, staples that we just talked about have very little correlation with reserves. So, if you think this is the year where the Fed's going to do 40 and then they're going to increase it because of liquidity, something to consider is which stocks, which assets do well in a liquidity adding environment.
Yeah. Brent, bring up this chart real quick. I just want to show you this one chart on the Fed balance sheet. This was circulating around a lot this morning. This is a chart of the QE that Mike's talking about, and there's been a very sharp increase in the Fed's balance sheet over the last about month. But what's really interesting about this, Mike, is again, this was it was like QE's back. This is going to mean the markets are going off to the moon. And of course, they only show this chart over the last 2 months where you've seen this increase in the balance sheet. But if you zoom back, really to the balance sheet as a whole, you can't even see it yet. So yes, there's QE coming into the market, but it's not the QE of the days of old where we were doing $120 billion a month and we were actually providing a massive amount of reserve contribution to the banks, and that was flowing into the financial system. It's definitely there. I'm not arguing with you, Mike, that it's not there. It's just, again, I love the headlines because people grab these charts and they throw them out there. It's like, look, QE's come roaring back. This means stocks are going to the moon. Yes, it's QE, but it's not the QE that you think it is, right? It's a different QE, at least at this
I'm
point.
gonna write an article on chart crime one day because there are so many ways. And look, Lance, I'm sure me and you are guilty of it too.
Sure.
You can manipulate any graph to tell any story you want, right? If you just show the last 3 months of the Fed balance sheet, the Fed's going gangbusters. What are they doing? They're pumping the market with liquidity.
Yep.
You pan it out 3 years and you barely even see what they did. And, it's just, we see it all the time,
Yeah.
this.
And to be
various
fair, and to be
versions of
fair,
chart crime.
to be fair, I am sure we have committed chart crime, but we do work very hard at trying to provide the entire context of
Right.
things when we do our charts. So, we show long-term correlations, we show long-term charts. We try not to, pick these, kind of cherry pick these points to where everything looks rosy in some particular, kind of form or fashion. We try to show the whole history just for that reason. But again, yes, we're probably all guilty of it at some point or the other.
Right. So the next big ticket item is that we know Powell's exiting. He's going to be gone in May. Trump has put out Kevin Hassett, Kevin Warsh. There's other names being floated around. I presume we'll know who he's going to nominate within the next 3-4 weeks. At least that's the vibe that's coming out of the White House. We've talked about this before. Kevin Hassett is more of a dove. Kevin Warsh is more of a hawk. Kevin Warsh doesn't like QE. So depending on who it is, what they say publicly, what they're talking about, there's a couple items to think about. One is just Fed independence. We can debate all day whether Fed independence will change, what it's been like, what it will be like, but what will the market think about it? What will the narrative be? And how will that affect bond prices, which ultimately affect asset prices, gold prices, stock prices, everything? The one thing I recommend is looking at inflation expectations to really gauge what the market is thinking. And I'm not talking about like the University of Michigan or consumer confidence or the surveys. I'm talking about like actual 1-year inflation swaps, instruments where people are putting their money to work. And what they show is that 1-year inflation swaps, for instance, are falling rather rapidly. So right now, the market does not have a concern that whoever Trump is going to put in there is going to unduly or bring interest rates too far down to create inflation. Of course, that can change, and that's why we want to watch something like that. If Warsh's name comes to the forefront and inflation swaps start spiking, that's telling you what the market's thinking. The other big one coming, it's really starting now, but it'll really gain speed mid-year is the midterms, the elections. Can Trump hold on to the House? I guess is the big question right now. If you look at the betting markets, poly market, there's a 60, 70, 80% chance that the Democrats take the House. They still think the betting markets still think the Republicans keep the Senate. Obviously, there's going to be a lot will change between now and then. And, it's not just the betting markets, but we'll start following the polls a little better and trying to get a feel for who's going to win, what that entails for fiscal policy, for all kinds of policies going forward. And that, again, I think that starts really kicking in around April, May, June, coming to a crescendo in early November.
Yeah. And again, look, markets like gridlock. So, if the Democrats do take the House in the midterms, basically nothing happens in Washington, and markets tend to like that. So that's not necessarily a bad thing, is my point. There's a couple of interesting comments in the chat, Mike. The big question for me is will Europe keep dumping money into the U.S. markets? Yeah, they will. If markets keep outperforming, and this is where economic growth is next year, and this coming year, sorry, I forget we're in 2026 again. But in 2026, the U.S. economy is expected to grow at 2 to 2.2%. The European growth, the EU growth, is about 1%. So that economic growth cycle is going to attract money from Europe into the U.S., particularly into the markets. If they continue to outperform this year, that's going to certainly be the case. So yeah, I would expect that. If we see a rally in the dollar, that will also lead potentially to a rally in the dollar, and also if we start to see bonds outperform, that'll drag more European dollars into U.S. markets. Go ahead, Mike.
No, that was a great point, what you just said there about the dollar. The dollar was down, 10% last year, give or take a little?
Like 9.5%.
So any foreign investor that put money into the U.S. lost 10% on a dollar before they made a penny on whatever investment they had their money in. And they were still putting money in the U.S. So in a stronger dollar environment, the incentive to invest in U.S. assets is even greater. So like you, Lance, I think our relative growth, even if we're in a recession and we shrink 2%, that's probably going to be less than Europe will shrink, or less than the rest of the world will, or the major developed nations will shrink. So on a relative basis, I agree that we're going to get the growth.
Yeah.
The other big item is the AI infrastructure. Boom. It just raises a million questions. Well, for starters, about this time last year, we were talking about DeepSeek. And all of a sudden, the whole AI game got thrown on its head. What are the new technologies going to be this year? And does that mean NVIDIA will still be who they are, and Google and Meta and, a lot of these open AI?
Yeah, but, that's also a good point about Europe versus the U.S. Europe is so far behind the development curve on AI that they can't. They're out of the race. It's now, the race is now between China and the U.S. So the big debate now is going to be, where does that funding really wind up, and where does it go to? And the race is on, and who can win? It's still anybody's race to win, but the U.S. has got a good lead in this right now. So but Europe is literally out of the game on the innovation side, and I think that's going to attract more dollars into the U.S. as well, just to chase that AI narrative as it continues to expand. The AI, we may go through some volatility in the AI market, but this race is still very early, and that development is still very early in AI. So that's also going to attract investment dollars into these markets. So, we're talking about bringing XAI public. We're talking about bringing, SpaceX public. That's going to attract a lot of foreign dollars into the U.S. as those things occur.
Right. There's a million questions, but I think the question that started to arise last year that will probably stay prevalent throughout this year is this 1999? Is this 1997? Is this 2000? Comparing it to the dot-com bust.
Yep.
And I think that's just going to be on the market's mind, and there's going to be doomsdayers that say it's March 1st, 2000. And others that say it's just the dawn in 1995, and there's still a long road ahead before the market grossly overprices the technology.
Yeah, true. Another good question here we're talking about this kind of market rotation earlier. Healthcare has rotated. We were adding to healthcare last September. It's now had a great run, and so now it's time to kind of start thinking about maybe rebalancing that. Question was how do we, how do we go about through these rotational processes, right? How do we decide when it is time to make a rotation? So when do we start buying staples and these type of things? And the answer to that is that you never know the exact point. What you're looking for is you're looking for when things are kind of out of whack with the rest of the markets. And you're seeing that in some of those areas in particular. So we've actually already started adding some defensive positioning to our portfolio. We bought a little bit of Philip Morris recently. Altria, not Philip Morris. We bought some Altria recently. We added, added
Verizon.
Verizon to the portfolio, and then we had swapped out one of our other staple stocks that we owned in the dividend equity growth model. And so, we've already kind of started making that rotational adjustment in the portfolio. It's still young. At this point, they're small positions, and this is the important thing about investing is these are never one-off things. Like you go all into something all at one time. What you want to try to do is just plant some seeds, and then if they start to sprout and grow, then you add to them, right? And so that's what we've done is we've bought some little small positions in this area, and if they begin to perform as we expect, we'll add to them. We'll bring them up to market weight and their target weights in the portfolio. and then allow those to help benefit the portfolio. And then, we'll start reducing, we'll take profits out of the things that have done really well that are now overweight our targets. We'll bring those back to target weights, and eventually we may even underweight those in terms of the portfolio, in terms of the target weighting there. But that's just the risk management process. And again, the mistake that a lot of investors make is like, oh, I've so-and-so said that this year, this is going to do great, so I'm going all into that sector. I got an email yesterday. It's like, what sectors do you think are performing the best this year, and which ones do you think will perform best if market's correct? Well, duh. Right? Momentum is winning right now, so momentum is probably going to be the case. But that can change, and it can change very quickly. So, picking a sector today as being the winner for this year is pretty much a fool's game, because you don't know what's going to happen. And the whole point of managing a portfolio is managing the environment as it changes. Go ahead, Mike.
No, great point. Be aware of the environment and understand all the things that are coming down the pike that can change that environment. Lance, but I would, one thing I would add to what you just said is a few years ago on SimpleVisor, we put out our absolute and relative analysis scores that help us visually see the rotations and between sectors and individual stocks and stock factors that help us gauge it and understand what's kind of moving into favor, what's moving out of favor. This Friday, Lance, it's not just employment. The Supreme Court is going to rule on tariffs. So that's another kind of big ticket item. Right now, the odds favor that they're going to strike them down. I'm not sure that's as big a deal as what's plan B. Trump has made it pretty clear that there's a plan B, that there will be, call it whatever you want, tariffs, taxes, a fee, or whatever, that's coming down the pike. What's the legality of that? Will it have to go through the court system? Will Congress approve, disapprove? Doesn't matter what Congress thinks. So I think you're due for a little bit of volatility, potentially starting this Friday. But then as the plans get revealed for how that's going to be replaced, you got the potential for more, I'm going to say volatility, but that could be upside. It could be downside, right? If the tariffs are strike and tariffs are gone and Trump says, you know what, the hell with it, I'm done with this tariff business, inflation estimates are going to come down pretty quickly.
Right.
So what does that mean? That should be pretty good for both the stock and the bond market. Again, it's just something that we have to see. And then, we could go through the litany of other items, all the geopolitical hotspots, the monetary policy, the debt risk. Remember, we were here last year. Bond vigilantes were out in full force telling us that the government was going to collapse in 6 months and bonds were going to 10% and inflation is going through the roof.
Right.
None of that happened. Bond yields fell a little bit. You don't really hear much from the bond. They've all moved to the gold and silver market now, where they're selling their debasement story because the bond market got tired of hearing it. And another one, Lance, that kind of snuck up on us 2 years ago in August, the yen carry trade. There's a lot of pressure on Japan to make their currency appreciate. Donald Trump is putting pressure on them as well. So can they appreciate their currency without upsetting those kind of yen carry trade dynamics? So, I just listed off 7, 8, 9 things.
Right.
There's, I probably could have made this a book and just gone through a litany of things that may happen this year. And whatever that book I wrote, there's going to be so many other things that were not in there. Yeah. Right. I mean, even in October, did we think what was going to happen in Venezuela was going to happen?
Right. Yeah, no, that's the whole point, though, is that the thing that upsets, so out of all the things that you listed, right, that you just went through, most of that is well known to the markets, which means the guys on Wall Street, and this is the thing that I think a lot of people miss in terms of when they think about these things. They're kind of like, I heard this guy said this is going to happen. Okay, if that guy said it, how many people have already thought about that? Because the smart money on Wall Street, they're arbitraging all of this. And, if they see a risk out there, if they're long a particular asset class, they're shorting something else to hedge off that risk in the market. So if there's a risk out there that again, the tariff issues. Supreme Court comes back and says, yep, tariffs are a non-factor, right? They can't be done. They're illegal. You've got to go do something else. The markets, if the market's already pricing in a probability that that's going to be the outcome from the Supreme Court, it's already priced into the market. So when that announcement comes, it's not going to move the market much. There's not going to be this giant upheaval all of a sudden that, oh my gosh, tariffs have been ruled, unconstitutional. They can't be done. The market's going to have already priced all that in. So the thing that's going to get the market is something that is totally unexpected, out of left field, that happens tomorrow. We wake up. DeepSeek was a really good example of that. Nobody saw DeepSeek coming. And all of a sudden, the markets had to process that very, very quickly in terms of what DeepSeek meant for the AI market and what it meant for future earnings of companies like Google and OpenAI and Meta and others. And so that's what caused that short-term volatility in the markets. And it took the market a little bit of time to process that all through and figure out what it actually meant. And that's going to be the thing that gets the markets this year. It'll be nothing probably that you or I have talked about, because what you and I are talking about are the logical things that everybody already knows about. And it's already been hedged off and arbitraged on Wall Street.
Right, it's priced in.
Yeah,
the market understands it. The reason prices are going up and down every day is because there's little bits of information that are flowing through the market that are basically bringing market prices up to speed with everyone's knowledge. You, Lance, me, anyone listening to this, Brent even, no one knows anything more than the market. The market knows all. I guess the only investors that know more are the investors in Congress. They seem to do very well. But
they always do very well.
Right. The point is, you have to assume the market knows everything. So what doesn't the market know? And how will that impact prices? And that's why I kind of poo-pooed the tariff thing a little bit on Friday. I'm not saying the market could go down 10% on Friday. It could go up 10%. But the market is fully aware that the Supreme Court is going to make their announcement. They have a very good idea that the Supreme Court is going to strike it down. Under what terms, we don't really know yet. So what do you know that's different from that? And if you think you have information that's different than that, then you have an advantage.
Right. Well,
unfortunately.
And also, too, I mean, we also have to think about it from this standpoint. The way Wall Street's going to look at this is saying, okay, great, you just struck down tariffs. What does that mean for earnings? Well, you just improved the earnings outlook for Wall Street because you've removed a tax, which is going to make earnings better for companies that are importing goods and services from overseas. So, potentially a repeal of the tariffs by the Supreme Court might send the markets up 3 or 4% on Friday. And
it might send the staples, the
Sure.
goods producers, those stocks, some of which are deeply, undervalued. Staples could be the big winner right now.
Mm-hmm.
And here we sit the day before that announcement, and they're among the most oversold.
Right. And the area that people are least paying attention to. So yeah, I mean, this is the whole point about, portfolio management and these type of things is that, don't get too comfortable with these things, these narratives that people put out there, because again, these narratives never come true because again, the market's already pricing all this stuff in. And the more outrageous they are, the least likely they are to actually happen. But, it's just, you don't want to let that impact how you're managing the risk in your portfolio, how you're allocating, how you're navigating markets. At the end of the day, all that matters is not what the headline is. The headline can come out tomorrow that aliens have now landed on planet Earth. Great. Okay. Nobody saw it coming. What does that mean? What Wall Street's going to look for is what does that mean for forward earnings? Because everything translates back to valuations and everything translates back to what I'm willing to pay today for a future earnings growth tomorrow. And if some event occurs that changes that outlook for earnings, that's the risk to the market. And so something that occurs that doesn't really change the forecast for earnings is not going to be the thing that moves the markets. It's going to be something that impacts either vastly changes the forward earnings outlook or as a credit-related event in the market that causes a problem on the funding side. Those are the two big risks that really impact markets long-term, then create these, when everybody's talking about, markets are going to crash. that's fine. Yes, markets are eventually going to crash someday. Yes, valuations are high. Yes, that means lower forward returns. Yes, all that's very true. But without a catalyst to create that valuation reversion, valuations remain elevated for a very long time. Because,
right.
go ahead.
All right, let's talk about the just average year, right? I said earlier, on average, we're up 16% from the first day of the year. We're down 11% on average, and we close up 9%. What if we go up 16% till February? We drop almost 25%, so we're down 11% come June, and then we just have a nice glide higher, so we end up 9%. That's a big that's your average year. That's your average, right?
You actually
How many people are going to...
Yeah, you actually did a chart on this. Brandon, you can bring this chart up. You actually did a chart on this. This is the annual kind of performance of the S&P 500 going back to 1970. And it shows you the high and the low for the year and the closing price. And what you'll see is that in every year, virtually every single year, you have a period of the year where you're negative for the year. So there are corrections that occur within every single year of 5%, 10%, sometimes a whole lot more. And the markets wind up positive for the year, even with that correction. We just had a 20% correction last year, and we ended up positive for the year, up 17%. It was a massive recovery from that 20% decline. That's a normal year within the markets. And this is the whole point about navigating volatility, is that that's what you should expect in the market this year as well. Expect volatility. Go ahead, Mike. Sorry.
Right. No, it's interesting. If I tell you right now, Lance, I'm 100% confident we're going to be up 9% next year. Every investor would just say, screw it. I'm just going to buy the S&P 500. I'm going to go skiing or golfing, and I'll come back in January and hear what Mike has to say next, right? But we could be up 16% in a month from now, and the market could drop 25%. Think about that. 25% is a borderline crash. And it's going to give everyone, even though we end up 9%, it's not a clean glide path. So it just, when the market's going up 4 or 5% and people are saying the market's going to crash, or it's kind of gliding nice and everyone's saying, oh, it's just going to keep going forever. That's not how years play out on average. There is a lot of volatility, and you have to understand what's rotating in and out of favor, what's causing it. Is there potential for a lot more downside, or is the market getting really cheap? And that's the navigation that happens that we do constantly. It's always changing.
Absolutely. So, all right, we've gone long today. Hey, I appreciate your time joining us today on the show. Appreciate that a lot. Be sure to buy the website and get your ticket for the upcoming summit. It's next Saturday. It's just like a little over a week away. Certainly would love to see you there. It's go to the website, realinvestmentadvice.com. Click on the link at the top. Get your ticket now. Mike will be there, along with Adam Taggart, Brian Dunlap, Daniel Kang, Ed Slott, America's financial planner. We're going to be covering a vast variety of topics, from market outlooks for this year, how to navigate it, how to trade it. We cover that all. Even Nick Lane will be doing a full presentation on SimpleVisor as well. So we got a lot of stuff, good educational stuff, all happening next Saturday, the 17th. Get your ticket now online, realinvestmentadvice.com. See you back here for Friday's edition of The Real Investment Show. Have a great day.